Luke, great to have you back and be able to catch up with you. A lot of things have happened since you and I last talked. What's top of mind for you?
I think top of mind for me is just there's a lot of conflicting signals right now, right? So you've got, weakness in some macro indicators that have been, from a fundamental standpoint, that have been very good leading indicators throughout my career. So you talk about cardboard box volumes are collapsing against tough comps, RV sales collapsing against tough comps, heavy duty truck net orders have been down for the last 6 to 8 months. The flip side of it is you've also got some fundamental things in the macro side that are looking really positive. So the factory U.S. manufacturing construction spending is absolutely exploding higher at an unprecedented rate. I mean, it has gone from like a rate where it's run 80 billion a year, give or take, over the last 20 years. It's exploded to $190 billion rate annually.
Wow.
And some of that is tied to what the government has been doing in terms of incenting reshoring and the inflation reduction. So on the fundamental side, you have these two things pushing against each other. And then where I spend a lot of time as well is on the fiscal side for the U.S. And you have here too sort of conflicting forces pushing against each other. So you've got U.S. tax receipts falling at the fastest rate in. I mean, really, your tax receipts are on a trailing 3-month basis year over year. You're in a bad recession already. They're down 25%. But here too, it's off very unprecedented highs. But they're down significantly. Flip side is you've got U.S. outlays exploding already, which is again also what you usually see in a recession. And some of it is because of not some of it. It is significantly due to some pretty unique historical factors. Number one, the increase in interest rates at the fastest pace in 40 years. And number two, that's hurting receipts. It's increasing outlays. And number two, the demographics are what they are. And the entitlement bill is picking up secularly. And that's driving that up. And so it's this really weird time because when you think about it and take a step back, if the U.S. increases interest expense 600 billion year on year, fundamentally, there's no difference between that and a $600 billion stimmy payment that we were doing 2 years ago. The only difference is A, who it goes to, and B, the marginal propensity to consume of who it goes to, right? So you give $600 billion to everybody in their bank account, we saw what happens. You give $600 billion to the wealthier class. Yeah. But it ends up in the economy at any rate. And so you're in this weird time. And I guess I would overlay that as well. You're now seeing U.S. shale production start to peak and roll over. And that has been a disinflationary force that has given the Fed space. Basically, shale's starting to look like a collateral casualty of Fed rate hikes and U.S. SPR releases for going after Russia, which is what I thought would happen all along, but it's starting to happen. So you've got this sort of really weird mix as we start to get to the middle of this year where you could see energy inflation pick back up. You've got deficit stimulus pushing up on inflation. You've got fundamental demand down in some areas pretty badly, up in other areas. And so it's just this really weird, for me, a really weird period of time to have a whole lot of conviction one way or another. It's like a big decision points coming.
Yeah, how about with, and something you didn't mention, and even pros aren't talking about it anymore. Don't you think we still have an ongoing banking crisis here in the U.S.?
Oh, yeah. Oh, absolutely. And
won't that overshadow all the numbers that we just talked about for the last 10 minutes? Something that it's bigger. It's a much bigger issue than, which part of the economy is doing better now. Don't you think?
I think that's exactly right. And thank you for highlighting that, because I should have brought that up as another factor that is a negative, where I think we are right now in the burn off of, I think there was a whole lot of people looking at that March, April, May, myself included, talking about it. I think positioning got very negative around it. I think we're seeing a reversal of that. Some of that is tied to the AI excitement, et cetera, whatever, Fed pause or transitory pause, whatever this is. But absolutely, this banking strains crisis. Number one, it was a fiscal crisis. This is still fundamentally Fed encouraged the banks to buy all these treasuries and then raise the rates on them. They're upside down, and that hasn't changed. And these deficits are getting worse. And so you're getting this period of time. I wrote about this a few weeks ago of you get into the back half of this year, you're going to have the Fed doing QT. The banks aren't buying treasuries in all likelihood anymore because they're still upside down. They're looking for help.
They're still going to the facility.
They're still there. Facilities
they're still,
rising.
We need it. Bring it. Bring it.
Yep. So, and then you still have commercial real estate, which is, people have stopped talking about it, but there's a whole lot of refinancings that are going to need to come in commercial real estate. They're going to need to come venture capital. I hear credible rumblings. There's a lot of stuff that's upside down there that's going to need to come to market. So you're going to have this, I called it a capital crunch coming in the next 3 to 6 months where the U.S. government's got to raise a bunch of money.
Yeah.
CRE needs to raise a bunch of money. Venture capital needs to raise a bunch of money. And in theory, that should be really good for the dollar and maybe gold and not a whole lot else. It starts to take us back to that sort of 2022 regime from kind of March of 22 to September of 22. Powell is maybe trying to foam the runway by pausing here for a moment. And I think that's probably a valid interpretation of what he just did. But the bottom line is there's not enough global balance sheet without the Fed. The Fed's going to have to come back, I think, or else, yes, you can burn down the RRP and that gives you some room. But at the end of the day, even with the RRP, there's not enough global balance sheet. The Fed's going to have to probably be cutting or growing its balance sheet again to prevent that from being risk negative. I think it's a very valid point, Dale.
Okay, so it being, maybe they're late to the party like usual. And, they see the whites of the eyes like, some type of risk event. Yellen used more banking consolidation. To me, that's code word for failures. So
I think that's probably right.
Do you think that they may take draconian steps and limit withdrawals to see that as a solution?
I think that would be right before yield curve control in terms of how they don't want to do that. So yield curve control is the Hotel California for the Fed, right? Where they're never going to buy the bond market when that happens. And I think it's a when, not an if. So they don't want to do that. That'll be the last thing to do. I think the second last thing they would do would be these deposit controls or something like that, because that is simply, the US dollar is the global reserve currency, and rule number one of global reserve currency, as it's been structured since 1971, is no capital controls. So you start putting capital control, that's a dollar that has major implications.
That's giving a win to the BRICS. That may be the whole reason then that they don't do that.
I think, I don't think they do that for that reason, because really the dollar typically is per view of Treasury. And so that would be a Treasury decision. And I just don't think they'll do that.
Okay. What do you think Bill Gates was doing in China? Didn't he give you his itinerary?
Yeah, who knows?
Why does Xi want to meet with Gates? I mean, he saw Xi. It's strange, isn't it?
It's very strange. Now, I will say, I'm out of my depth a little bit here. This is not.
But you were talking about that. It won't serve the U.S. to decouple. I think there were some comments out of Europe today echoing what you were saying, that nations can't afford to decouple from China.
No, they absolutely can't. And I think
China can't afford it either, can they?
No, what you're talking about, if you get a hard decoupling, however that happens, hard decoupling economically, some sort of hot war, you're going to get basically a soft version of instant global hyperinflation everywhere. It'll be, I think the right way to think about it is the post-World War I analog, right? Where you're going to have China, who's got a whole bunch of factories and no place to sell the stuff. And so they're going to have to create some sort of domestic wooden nickel program, domestic stimulus, right, to basically create consumers overnight to buy their own production. So they're going to have deflation in China, and then in areas that are short energy or short other goods, the U.S. really is running this gigantic current account deficit, right? So we're
Right.
$1 trillion trade deficit that is going to be short goods. So you're going to be short $1 trillion of goods. That is a way to think about it, minimum, assuming there's no sort of, goods go into
We're
goods
short
here.
a lot of oil right now too, aren't we, Lou?
We'd be short. Yeah. We'd probably be short oil, but then we'd be short buyers of treasuries. So you're going to be, you're going to have no place for your treasuries, and you're going to need a lot of stuff. And that's a really toxic combination where rates go up and inflation goes up, and the bond market crashes globally overnight in a hard decoupling. So I see these people talking about it, and I don't know whether they're simply jawboning or trying to establish a position, or whether they're not thinking of the second derivative, which unfortunately this administration, the administration before, last several administrations in this country haven't done a lot of second and third derivative thinking. They just sort of act and then deal with the consequences. So maybe she's trying to talk to Gates as a business person with experience there to say, hey, what's really going on here? Who knows? But a hard decoupling would be very, very tumultuous for markets.
Okay. The overriding, so on the business plane, they could come to terms, but it sure seems like we're still poking the tiger in the eye with trade pacts with Taiwan that just passed. And it seems like we're playing like a, dual game. Let's do business, but we're not going to let you take Taiwan, and we're going to supply them.
Yeah, and to me, it all ties. It's fascinating, right? My late father-in-law was a Teamster official for a long time, and I used to play golf with he and a couple of his buddies. That one of whom was an old Italian Cleveland guy. So the conversations were always really interesting. But this was, call it 01, 02, 03, 04, 05, right when China goes into the WTO, and what the U.S. administration and some of its senior policymakers and think tanks are saying about China today are what these guys were saying about China 20 years ago. And like these guys collectively, the other three I played golf with every week, they collectively had 0 days of college amongst them, but they were very street smart. They understood business, and they were asking like, okay, like I get it. You're going to lower labor. You're going to lower labor costs. You're going to take away the power from unions, but then what?
Yeah.
Then you're going to be
hollowed out.
Yeah, exactly. And that's exactly what's happened. So to me, a lot of this rhetoric, I think, is on some level lashing out because the U.S. realized they've made a mistake. They've been had. They were outplayed. Based on someone willing to look a bit longer. And now, you look, Taiwan makes 90% of the world's semiconductors? Like we're not, what are we, the U.S. has to make a choice. We want to bring semiconductors back. Terrific. Let's do a $5 trillion stimulus, $5 trillion printed out of thin air, monetized by the Fed, trillion a year invested for the next 5 years. And that's assuming we could find the labor and this and that and the other. But then the bond market gets killed on a real basis. The Fed has to come in and monetize the bond market. And that's when you do a lot of dumb things for 20 years straight on borrowed money, you find yourself in a position where there's not a lot of good choices anymore. There's just varying degrees of bad choices. And I think some of this poking and seemingly incongruous actions from the U.S., I think, are on some level a reflection of the reality that they've cornered themselves, that there's no good actions. And it's not like China has issues of their own, but strictly from our perspective, the poor chronic short-term decisions we've made for the last 20 years are coming home to roost.
Well, I read your stuff, and you say we're getting closer and closer to an end game. I'd like to know when you think that might be. Could it be next year? I know Gann has 24 as a bad year. I mean, we're going to have all kinds of stuff happening politically. and we're gonna see what the Fed is going to do, and I'm wondering if your end game ends up being that something we didn't employ, but you felt we had room to a few years ago, were to go to negative rates, and that you said even when we were near zero that they still could fall a lot further. There was historical precedent for them to fall further. Is
On a
that
real
part of
basis.
the end? Is that part? So maybe we're peaking in yields here, and that's going to be part of the end game.
On a real basis, yeah, absolutely. I think we probably are peaking in real yields right here, and I think, yeah, when you talk about 24 being a bad year, I would say when's the window for that sort of end game of the of real rates heading back to significantly negative rates? I would say the window's open now, and the reason I say the window's open now is of that couple parts of that toxic combination that we talked about at the start, which is, number one, you've got this potential credit crunch coming up, right? Where you've got the U.S. government's going to have to borrow a lot, CRE, VC, all of that's going to start playing out in the back half of this year and into first half of next year. That's number one. So those guys need lower rates. Number two, you've got the U.S. fiscal situation leading to it's untenable, and it's leading to higher levels of inflation, right? Where the U.S. government's, they're 25% of GDP, deficits at 8% of GDP. You have a recession. Last three recessions, we've seen deficits go up 6, 8, and 10% of GDP, and we're already at 8. So in a recession, we'd be looking at 6 plus 8, 8 plus 8, 10 plus 8. We'd be looking at 14 to 18% of GDP deficits, nearly World War II level deficits, and foreigners aren't buying enough of them. And in fact, in a recession, the dollar's rising, the foreigners are going to be selling treasuries like they were last year. So you're going to look at net effective supplies of treasuries, probably near 20% of US GDP, 5 trillion a year. There's nobody with that balance sheet. So you're going to have
that's crowded out. That's crowding out all the other borrowing that has corporates, municipalities, everybody.
All of it. And the third thing I would say that, so that's, you layer that on, and that's why I say the window's open. And then the third thing is peak cheap energy, where the U.S. made a bet effectively when they ran down the SPR at the fastest pace in 40 years, that basically Russia would break before U.S. shale would break. Russian oil production or the Russian political situation would break before U.S. shale. And the bottom line is, yes, oil's down. Yes, Russia's deficits, our fiscal position is straining more than it was a year ago.
Yeah.
But Russia's oil production is still up. They are okay. And shale is rolling over. And shale is a very unique geological animal in terms of, once it rolls hard. It has a very high natural decline rate. And so the point here is you're going to be looking at this deflationary impulse of a credit crunch, the inflationary impulse of the fiscal crisis, and then oil actually starting to rise again underneath them. That is the absolute toxic, cocktail.
Cocktail. Yeah, we'll all be drinking that cocktail.
Yeah, that's exactly it. And I think volatility will rise meaningfully. I think there will be times when it's really good for the dollar, really bad for the dollar. You're going to see, I think we've already started to see the volatility in things that most of us have never seen in our careers, right? When we go back to March and the 2-year treasury yield trades like Dogecoin, I think that's going to become much more normal. I think gold going up 50 and 80 points, in a 100 points in a week, that's going to be normal. I see Ronit saying, Dixie up 10% in 10 days. Exactly. That type of stuff, I think, is going to become more normal as, like I said, this window opens with these 3 big factors that are very
historically. No one's worried. My proof is VIX 14.
Oh, right
There's
now it's really
complacency like I've never seen.
Yeah, that's like AI is going to fix everything, and positioning of AI. Everybody knows about the credit crunch, and it reminds me a little bit of if you remember, like the April, May, June of 2008 timeframe, where, or even maybe even 07 is probably the better analog, but either one of them, right? There was like this period of time where Bear Stearns blew up. And then George Bush came in with a stimulus, and everyone was like, oh, well, stimulus is going to make it just fine. And I remember talking to clients like, are you kidding me? There's all this other stuff yet on the come. And
it took a year. Well, I think it was I
Yeah.
think it was Washington Washington, whatever, that bank.
Yeah, Washington Mutual. Yeah.
Mutual,
Yeah,
right?
Wamos. Yep.
And then it was Bear Stearns. And Lehman
Yeah.
didn't happen until what, a year after Washington Mutual.
Yeah, exactly. And it was, so there's like this complacency of like, okay, well,
We have
remember, I
time.
think it was May of 07 when Bernanke's like, oh, subprime, yes, there's a problem in subprime, and subprime is contained. Like the stock market didn't even peak until October. So you had another 5 months of gains in the S&P. And then there was just catalyst. And I think the catalysts start to come fast and furious in the next, 3 to 6 months. But there's like this optimism. Hey, the Fed stopped AI, productivity. And then I think we're going to have that with punches in the face of reality. Like, oh God, oil's back at 80. Oh God, oil's back at 90. And oh God, the fiscal deficit is, oh gosh, the big commercial real estate,
You never know. It's like one last snowflake causes the avalanche.
That's
the
exactly
tipping
it.
point. You never know.
The 10 years at 4.5, or it went back to 4. Now it's at 4.5. And and that'll be enough to sort of go, oh, wait a second. Like, why do I own tech with the 10-year at 4 on its way to 4.5 in a hurry? And the answer is you probably don't.
I'll tell you what, people, if you want to learn a lot, this is where you go. Go right here to Luke's website here, FFTTLLC.com. And you can, check him out, get, some of his stuff that you're prepared for these times. And this is historic and maybe the biggest, change in our lifetime. Last thing, Luke, do you think that the Fed, since you said they knew the banks loaded up on their paper, per direction of the Fed, help us out, buy this stuff, and then they go up to 5%. They knew they were going to take down banks by doing this. They knew it, don't you think?
I think
intentional.
I don't think it was intentional. I think the Fed, the big bet underlying it all was inflation would never come back. Like, I think that was the thing that surprised them all. I think they really thought was that inflation was never going to come back. And then also, when you go back to August 2019, Stan Fischer, who was the former vice chair of the Fed, wrote that paper with the head of the Swiss National Bank and the former governor of the Bank of Canada. And they said, in the next crisis, we're going to go direct. We are going to have the fiscal side print a bunch of money and spend it into the economy. And the central banks are going to cap yields and real rates are going to go very negative. And inflation will be very tricky. Once you let it out of the bag, it's very tricky, but this is what we're going to do. And it's interesting. So Fisher was Bernanke's teacher. He was Draghi's teacher. He's the godfather of central banking. So I think they on some level, so I would restate a little bit what I just said before about this inflation suppressing thing. I think they did exactly what Stan Fisher and others said they were going to do in the next crisis. COVID, they spent a bunch of money. The Fed capped yields. They had the banking system help them. I think what changed was the political situation in Washington, because it looked like they were running that playbook. And then all of a sudden, February, March of last year, the Fed gets panicked about inflation. And I think the Russian invasion changed things as well. I still think there's an element of what the Fed has done was a weaponization of the dollar to try to punish Russia. And I think those two factors combined basically changed the rules in the middle of the game for these banks. And you kind of go, well, what the hell? Like, you got me to buy this stuff, and now I'm upside down to the tune of hundreds of billions of dollars, collectively as an industry. So I don't think they did it on purpose. I think they were surprised by the pace of inflation, or panicked maybe, but panicked because of the political situation.
Well, they could have told people to do something about duration. They knew they were going to take rates up dramatically.
Yeah,
and you would think nothing.
They did nothing. And my understanding, and I don't know if this is the case, but there's people I respect that have pointed this out to me, that the accounting treatment for banks is such that they have to move it, I think, out of held to maturity to available for sale if they apply hedges to it, which means they have to take the marks on a daily basis. So there was actually apparently a strong disincentive to do that, right? Because basically, if you're a bank manager, and again, I've heard this, I've not done this myself, but some people I respect have pointed it out to me. But if that's the case, if you're a bank manager, you're stuck, right? You're like, do I hedge and come out to Wall Street and take down my earnings 20%? Or do I just bet that the Fed's going to stop and reverse and just leave it in held to maturity? And for 25 years, the right bet has been wait, held to maturity, put it in held to maturity. The Fed's got your back. And so it was a rule change mid-game, I think, that surprised a lot of these guys.
Yeah, hope. Hope is the oxygen in our lives and the carbon monoxide in our investing.
Yeah.
What do you think, huh?
I like that one.
Well, Luke, great catching up with you, and really appreciate it. One more question. We're going to have digital currency here in the U.S.
I don't think it will be widespread. I think it will be to, if you look at the unemployed workforce, the part not counted in the labor force group.
Okay.
I think, that will be, digital. I think welfare benefits and certain healthcare and entitlement benefits will be paid that way. I don't think you'll see it broadly, but I could be totally wrong on that.
Okay. I hope you're right. And appreciate you being here, buddy.
Yeah, absolutely. Thanks for having me on.
Yeah, great time. And congratulations on being on CNN.
Oh, I appreciate it.
It's great that you're getting your message out, because I consider you a watchman for all of us.
Thank you. I appreciate that.
Luke Gromen, everyone, follow him on Twitter at Luke Gromen and get his stuff. You're going to need to know what he's thinking during these times. Thank you, buddy.
All right. Thanks for having me on, buddy. We'll have a great day.
All right.
Bye-bye.
Luke Gromen, everyone, and you could join the team in 14 minutes on the morning edge. Adios. Hope you enjoyed Luke. Okay. So he sees it getting closer. We can't go on forever juggling 100 balls in the air without dropping a few. That's my view. And don't forget to not just count your pips, count your blessings. We'll see everyone tomorrow with the markets cooking.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.